Welcome back to Investing Outside the Box, where we explore strategies and opportunities that go beyond the traditional stock and bond portfolio. I'm David Harris, founder of Alternative Investment Advisors. Today, we're diving into one of the most enduring and evolving corners of the alternative investment world, private real estate. Why? Because while public equities swing with every headline and bonds struggle to outpace inflation, private real estate remains one of the most reliable ways to generate income, preserve wealth, and participate in long-term appreciation. Whether you're a seasoned investor or just curious about how these deals actually work, I'll walk you through the key elements, from preferred returns and upside potential to tax advantages and risk management, so you can evaluate opportunities with clarity and confidence. Let's dive in. Real estate has always been a tangible income-producing asset class, but in today's environment, it's even more compelling. We've seen interest rates shift dramatically over the last 2 years, creating both challenges and opportunities. Multifamily housing remains resilient thanks to persistent housing shortages. Meanwhile, parts of the office market are undergoing structural change, forcing investors to be highly selective.
So when they are interested in real estate investing, I mean, that's such a broad thing to do. You can own apartments directly, or you can be in a REIT, or you can be in, I'm sure, many of these private vehicles that maybe they have access to that people wouldn't. What kind of real estate investing?
So obviously there's all these sectors, office, but residential would be the largest. Direct ownership, garden apartments across the country, multifamily, high-rise, a lot of retail. In the last 5 years, industrial has been screaming, coming back a little now. But you'd have to say industrial's been the strongest and multifamily the most constant. Biggest flux is retail and office.
Here's the key. Real estate isn't one monolithic market. It's a mosaic of sectors, each with its own drivers. That's why for high net worth investors, the decision isn't just should I invest in real estate, it's which strategy in which sector with which sponsor. When evaluating a private real estate opportunity, structure is everything. Is it an equity deal where you participate in income and appreciation? Or a debt deal where you're essentially the lender? Is it single asset which offers concentration but transparency? Or a diversified fund which spreads risk across multiple properties? Is it development which carries more risk but higher potential returns? Or a stabilized property delivering predictable income? And just as important, where do you sit in the capital stack? Senior debt, mezzanine, preferred equity, or common equity? That position determines not just return potential, but how protected you are if things go wrong. One term you'll hear constantly in private deals is the preferred return. Think of it as your baseline. If a deal offers an 8% preferred return, investors are entitled to that return first, before the sponsor takes their share. Once that hurdle is met, profits are split, often 70-30 in favor of investors. And if it's cumulative, any shortfall rolls forward until you're made whole. This is where high net worth investors can really benefit. It aligns incentives, you receive priority income, and the sponsor only wins big if you win big.
All right, welcome back. Let's talk about money. Because while they say the rich are just like the rest of us, it's not exactly true, at least when it comes to investing. So you guys come out with these asset allocation reports. What I'm always shocked by, and I probably shouldn't say this on this network, is that stocks, your group, your teams love them, but they like them. They don't love them, right? They're still not the highest. They love real estate.
We love real estate, private particularly, and private equity. Both are at 28%. So 56% in the private markets, 24% in public equity, and a lot of it in ETFs and indexes. So stock picking is sort of fourth on the list.
One of the most overlooked but powerful aspects of private real estate is tax efficiency. Depreciation, especially when accelerated through cost segregation, can shelter much of the income you receive. Your taxable income can be significantly lower than the cash hitting your account. For larger transactions, 1031 exchanges allow deferral of capital gains by rolling proceeds into another property. And certain projects located in qualified opportunity zones offer not just deferral, but partial exclusion of gains if held long enough. For high net worth families, this isn't just about boosting returns. It's about protecting capital, preserving wealth across generations, and building a more tax efficient estate. Of course, no investment is risk free. Market risk. What if rents soften or cap rates expand? Leverage risk. Is the debt fixed or floating? Conservative or aggressive? Tenant risk. Is income tied to a handful of tenants or diversified? The best sponsors mitigate these with conservative underwriting, prudent financing, reserves, and tenant diversification. As an investor, you want to see those safeguards spelled out clearly because that's where stability is built. One thing you must accept with private real estate is illiquidity. Unlike a stock, you can't just push a button and sell. That's why understanding the exit strategy is critical. Is the plan a sale after 5 years? A refinance with partial return of capital? A long-term income hold? Your comfort with that timeline should match your portfolio goals.
I'm always looking when I'm buying properties to have an exit strategy. How quickly can I exit this and can I make profit on the exit? So I try to buy right when going in and I try to buy properties with multiple X factors. Things that I can improve the value, things that I can increase the value and either look to have an exit strategy on. Now, typically for me, when I'm buying residential property now in my journey, I'm looking at buying those properties, adding substantial value and then potentially moving them on if the cash flow is not right. So I'm happy with where my balance sheet is. I'm happy with my denominator of my portfolio. Now I'm just trying to accumulate chunks of capital to do bigger and better things. I don't have unlimited borrowing capacity, although I do have very strong borrowing capacity the way I've structured all my investments, but I can't just go to the bank and ask for $20 million. I've still got to prove to them that I've got a chosen strategy that works, so they back me in the deals that I choose to do.
Illiquidity isn't a weakness. It can be a strength, protecting you from the urge to sell at the wrong time. But you have to know the plan going in. For high net worth investors, alignment of interests may be the single most important factor. Does the sponsor have their own money invested alongside yours? Are the fees, acquisition, asset management, disposition reasonable and tied to performance, not just transactions? When you and the sponsor are truly aligned, you're rowing in the same direction. And that's when the best results happen. Let me bring this down to earth with 2 examples that illustrate the spectrum of opportunities available. First, Hamilton Point Fund 15. This is a diversified multifamily fund targeting institutional quality apartments in growth markets. It gives investors access to scale, diversification, and professional management typically reserved for pension funds and endowments. For high net worth families, it's a way to participate in the stability and long-term appreciation of high-quality housing without having to operate properties yourself. Now, let's contrast that with FG Communities. Their offering is focused on affordable manufactured housing, one of the most resilient sectors in real estate. It pays an 11% preferred return, which is significantly higher than most offerings in the market, and investors receive warrants for additional upside. That means you're not just collecting strong current income, you're also participating in the long-term growth of the platform. Hamilton Point represents institutional stability. FG Communities represents innovative yield with growth optionality. Both have a place in a high net worth portfolio, depending on whether your goal is steady, multi-generational stability or enhanced income with equity upside. So here's the bottom line. Private real estate can deliver income, appreciation, and powerful tax advantages. But success depends on choosing the right structure, understanding the risks, and working with sponsors who are aligned with your interests. For high net worth families, these are not just transactions. They're building blocks of legacy planning, diversification, and wealth preservation. If you'd like to explore these kinds of opportunities in more detail, I invite you to connect with me directly at altsadvisors.com. And be sure to join me next week when we'll be shifting focus to another critical corner of the alternative investment landscape, private debt and credit, an asset class that's gaining massive traction among institutions and increasingly among high net worth individuals as well. Thanks for tuning in to Investing Outside the Box. I'm David Harris, and I'll see you next time.